Fusion Mobile, quality e-learning experience on the go.
You are welcome to Fusion Mobile e-learning platform. I'm Odokobe Pelumi by name, commerce teacher. So we'll be looking at topic insurance in this class, and on the topic we'll be looking at the definition of insurance and assurance. We'll also be looking at insurance and looking at insurable and non-insurable risks. We'll be looking at the basic principles of insurance. We'll be looking at type of insurance like marine insurance, life insurance. But we have a lot of them. Also, we'll be looking at underwriting and reinsurance. We'll also be looking at the middlemen or intermediaries. Thereafter, we are going to look at the importance of insurance. Then move to procedures of insurance contracts. Thereafter, we're going to look at terms frequently used in insurance industries. Now, the first thing we have is the definition of insurance and assurance. Insurance also serves as one of the words important aids to trade. So it helps to facilitate the art of buying and selling. So insurance is also a form of what? It has been referred to as the pooling of risks. So insurance helps to pool risks in the business, how to pool risks of the business. So when talking about insurance is not an agreement whereby one party undertakes to indemnify or to give compensation to another party as a result of the party suffering a loss. So whenever a party suffers a loss, what happens? Insurance will undertake to compensate such a party. And how will that happen? Such a party that is to be what? That should be compensated, that is the insured party that is to be compensated. We have to pay some certain amount of premium to the insurance company. So it is from this premium collected from the insured person in which the insurer will be able to make that available when the insured person suffers a loss in the future. So this is from out of this premium given to the insurance company that insurance will be able to use for compensation to the victim who suffered a loss. So, and that losses will be calculated the premium will be given based on the losses suffered by the victim or by the insured person. Now the next thing we have is the assurance. It is also a form of insurance, but totally opposite from insurance, because assurance huge on eventuality that will occur. So it's making provision for some of eventualities in the future which will surely occur in the future. Example is making provision for life insurance, because in the future surely death will surely come. So now we are going to look at the differences between insurance and assurance. There's a lot of differences between insurance and insurance. Number one is that insurance is making provision against eventuality that may not occur. It's making provision against risk that may not occur. So when you make provision for insurance, it means you are making provision for risk that may not occur in the future. Why assurance is making provision for what? For risks that will certainly occur in the future. And again, when talking about insurance, is that insurance is based on probability, because it may not occur. Why assurance is based on what? Possibilities. Surely what occur. So the next thing again is that insurance is example of an insurance policy is fire insurance. We can talk about fire insurance. We can talk about motor insurance. While example of assurance policy is life assurance, because life assurance, so it's insurance based on what? Death. So life assurance policy is an example of what is assurance. Now that is the major difference we can look at between the insurance and assurance. Now the next thing is to look at the insurable risks and non-insurable risks. So we are going to look at insurable risks and then non-insurable risks. Wow. Now the insurable risks. This is a class of risks in which the insurance company or the insurer can make provision for, because it's possible that these losses or these risks can easily be calculated and make provision for, so and be estimated. So the insurer or the insurance company can make provision for these kinds of risks. So it means this kind of risk can be insured with the insurer or with the insurance company. Why example of such type of insurance is motor insurance and fire, burglary. We are talking about theft, when we are talking about car accident and so on and so forth. So this these losses can easily be calculated, they can be estimated. So the insurance company will be ready to make provision against loss that arises from such a risk. So we call such a risk what insurable risk, because such a risk can be insured upon. Now the next one we have the non-insurable risk. This category of risk cannot be insured upon. Exactly, they cannot be insured upon. This category of risk cannot be insured upon. So the insurer cannot make provision for this category of risk because such a losses or such risk cannot be easily calculated and be estimated. So insurance company cannot make provision for such risk in the business. Example include gambling, fashion, change of loss of profit due to change in demand, a lot of things like that will form the non-insurable risk. So loss of profits due to change in taste also, change in gambling businesses, gambling also, loss as a result of gambling. Insurable company cannot make provision of that because the losses cannot be estimated and cannot be calculated. So reduction in profit due to change in demand, change in taste, the insurance company cannot make provision for such risks. We have a lot of non-insurable risks, so we search and read and learn more about the non-insurable risks. Now the next thing is the basic principles of insurance. There is a basic principle of insurance. Everything has to follow some aspect of principles. There are some principles that urges on insurance. So for you to have perfect knowledge of insurance, you must be able to know these principles often. You'll be able to understand what these principles are saying. You have the list of these principles. We have number 1. We have indemnity. We have number 2. We have insurable interest. Number 3, we have insurable interest. We have utmost good faith as very fides. And next one we have we don't have utmost good faith. Then the next one is the contribution. Next one is the proximate cost. So next one is the proximate cost. Next one is actually the subrogation. And lastly we have abandonment. So we have the abandonment. So the first one we have is the indemnity. So what this principle is telling us that the insurer or the insurance company will give the word insured so a certain amount of compensation if such an insurance should suffer a loss. When the insured person suffer a loss, so compensation will be given to the insured person, and that is what the principle is telling us. The principle of indemnity, that serves as compensation given to the insured person as a result of it suffering a loss. That is one of the principles. So person taking an insurance policy must know that okay, there's some certain form of what indemnity that will be given to him whenever he suffers a loss. So that is what the principle is telling us, that okay, whenever the insured person suffers a loss, some certain amount of what compensation will be given to the person. So that means the person will be indemnified. The person will be indemnified after service a loss. So whenever the person suffers a loss, what happens? The person will be indemnified. And the next thing is the insurable risk. Insurable interest. Wow, this is one of the interesting policies of insurance. Insurable risk. Insurable interest, rather. Insurable was interest. What this principle is telling us is that a person that is to make an insurance policy must make that policy that will bring loss upon himself. So that means whenever you want to insure some property, that property in which you are insuring you must be the owner and it must be done in such a way that that property must be able to bring some certain amount of liabilities to you and some certain amount of what losses to you. That means in the insurance policies, you don't have the right to insure the property of your neighbor or the property of your brothers. So that any property you are to insure must be able to bring what losses to you directly and not to any other persons. That is what the insurable interest is saying. That means a person must have a direct interest with any property is to insure, or with anything he is to insure. That means in such a way that that property, in the event of what, in the event of any certain eventualities, that thing must bring some certain amount of liability and losses to him, not to someone else. So that means this principle is telling us that you must be able to insure your own property, not someone else's property, like your brother and your neighbor. Now the next principle you have is utmost good faith unverified. So what this utmost good faith is telling us is that all of the relevant information as regard to the contract, because insurance is a contract between the word insured and the insurance company or the insurer. So whenever a contract is to be made between the insurance company and the insurer, this means that the insured person must make all the relevant information was open and confidential. So all the relevant information as regard to the contract must be made known to the insurance company. So if you have to make a policy with an insurance company, you must make sure that you disclose all relevant information as regard to the contract. That means if the contract is open, you must make all relevant information. Like for instance, a person that wants to take life assurance policy, and that person is having a cancer and he refused to disclose such an information to the insurance company. If as a result of the death of the person, the insurer will discover that okay, this person is having a cancer and may refuse to compensate such an individual, and as a result of that, the information, the relevant information which is very important to the contract, is not being disclosed to the insurer company, because cancer can actually bring about death easily. So what happened? The insurance company will refuse to compensate such a person because the relevant information is not being disclosed to the insurance. Also, that is what the utmost good faith is saying. It means the person making an insurance contract must be of good faith with the insurance. Make all relevant information known to it as regard to the contracts. Now the next one is the contribution. This principle is actually telling us that if a single person make a lot of insurable policies with many insurance companies as regard to one property, or as regard of one insurable items, it means if the loss or liability should arise, and that person cannot claim compensation in full from each of these insurance companies. So if you insured your property, your single property, your house with many insurance companies, you insure your single houses, just a single house with many insurance companies, and this house, the loss or liability in which you insure the house against arises, it means you cannot collect compensation in full from each of these insurance company, because you are insuring just a single property on many insurance policies. So when the losses arise, what happens? Each of these insurance company will refuse to make compensation in full to you, because that is one of the principle of contribution. So what happens? Each of these insurance company will contribute to compensate you, so they won't make compensation in full. So you have to take note of this of these principles of contribution while making an insurance contract. The next thing we have is the proximate cost. Wow, interesting, the proximate cost. That it shows that the insurance company will make provision for compensation as directly to the property insured. So it means insurance company is responsible in making provision with the insurable interest that arises. If for instance you insure your car against an accident, what will happen? The insurance company will only compensate you if the car actually had an accident. If anything should occur, if there's any rise of if there's any cost to the car, what will happen, which is not proximate to the insurance contract, which is accident, what will happen? The insurance will refuse to compensate you. What will happen? The insurance will only compensate if the car should had an accident, if anything should happens to the car, if any cause should happen to the car, and that cause is not proximate to the cause of what which you insure the car against, what will happen? The insurance company will refuse to compensate. If, for instance, like I said earlier, if you insure your car against accident, what happen? The insurance company will only compensate you if the car should had an accident. If the car should get burned through fire, what will happen? The insurance will refuse to compensate you, because what you insure the car against is accident, not actually by fire. So that will happen. The insurance company will really compensate if that is of direct and proximate cause. So next thing we have is the principle of subrogation. Interesting, principle of subrogation. This principle is telling us that the insurance company has the right to take over all of the property and all of the items of the insured person after the insured person has been fully compensated. It means once the insured person has been fully compensated, the insurance company has the right to take over all of the insurable properties of the contract. So that is what the principle of subrogation is telling us. So the next one we have is the principle of abandonment. The principle of abandonment means if at all in any insurance contract a form of liabilities or losses arises, and that losses that arises is more than the economic value, that is the process of making compensation is more than the economic value, that is the cost of replacement of that asset or property, what will happen? That the insurance company has the right not to repair or not to make maintenance to such liabilities. So the insurance company has the right to abandon such items and get a new one to such an insured person. Maybe a person insured is cars against damage, and the damage which arises from the cars is much in such a way that the cost to repair such car is much. So what will happen? And so it's better for the insurance company to get a new car for that person. So the insurance company is having the right to abandon the old car and get a new car for the insured person. That is what the principle of abandonment is telling us. Now the next thing we have is type of insurance. We have many types of insurances. We have marine insurance, we have life insurance, assurance or life insurance, we have fire insurance, we have a lot of insurance. We have theft insurance, we have fire insurance has been there, we have fidelity insurance, we have employees insurance, we have a lot of them. We have burglary insurance, a lot of them like that. So we are going to look at each of these type of insurance one after the other. We have next on the list is the types of insurance. So what we have next on the list is types of insurance, and these are some of the few types of insurance. So we have the bad debt insurance, we have the goods in transit insurance, the group insurance, the cash in transit insurance, you understand? We have the fidelity guarantee insurance, we have the plate and glass insurance, we have the burglary, theft and robbery insurance, we have marine insurance, life insurance, our assurance, and we also have the fire insurance. We have a lot of them. These are just a few lists of it. So we are going to explain bad debt insurance. So this type of insurance that is insured against any form of losses or liability that arise from the refusal of the reward or the debtor. So that means any debt that cannot be recovered again will be compensated back to the creditors or to the owner of the business. So by the insurance company. So goods in transit insurance also this is to make provision against any form of liability or losses that might arise as a result of loss of goods in transit. So when there's loss of goods in transit, what will happen? Insurance will make provision for that and provide compensation for that. Now the next thing is the group insurance. This is usually used to compensate group of workers within an organization. So if anything should happen to any of these workers, what happen? Compensation will be made by by making such provision for such liability that arises. So if a workers should fall sick, for instance, among the group, what happen, the insurance company will make a provision for that and will treat such a person. And the next thing is cash in transit. So this is to make provision for liability or losses that arises from what loss of cash in transit. So once there is loss of cash in transit, what will happen? The provision will what the insurer or the insurance company will make provision for that. Now the next thing is the fidelity guarantee insurance. This arises, or this is to make provision for losses of liability that arises as a result of mistrust employees. So it means employee that has been being put in post of honesty and also trusted by the organization. So whenever such a our employee was failed the organization, what happened? If maybe there is stuff and you understand in the organization because of the trust being put upon such an employee, what happened? A fidelity guarantee insurance will bring about making provision as a result of losses that arise as a result of dishonest of that employees or staff. The next is plate and glass insurance. Wow, interesting. This is making provision for all of the all of the plates, spoons, cutleries you have at home, and also glass you have at home. So you can also make provision for losses that may arise against them. So in advanced country, people usually make provision for against losses that may arise for plates, you understand, losses that may arise from cutleries, you understand, spoons and also glasses. So the breaking of glasses also we can make provision for that. So a lot of people that have their house built of glass to make provision for for losses that may arise as the brokenness of such a glass. The next thing is marine insurance, and have life insurance and fire insurance. This insurance has a lot of details. So this is what we are going to treat much. We are going to talk much about the marine insurance, the life insurance, and the fire insurance. So we are going to take them one after the other. Because we have much details again to talk about. So we are going to treat them one after the other. We're going to take marine insurance, for thereafter we'll move to life insurance, and thereafter we'll move to fire insurance. So we can talk about the marine insurance. So marine insurance is making provision against losses or liability that arise from the peril of sea or the damage of ship and its cargoes on sea. So that's what we call the marine insurance. So the insurance company is going to make provision for any form of damages or any form of perils made by the sea to the ship or its cargo. That's what the marine insurance is all about. So we have different types of marine insurance. We have the oil insurance, we have the cargo insurance, we have the ship owners insurance, and we have the freight insurance. Now the oil insurance, what the oil insurance is all about is that the insurance company is going to make provision for all of the losses that was to the body of the ship. So all of the losses and the cargo, the insurance company is going to make provision to that. So any liabilities that arises from the damage caused by the sea to the ship and also to the cargo, the insurance company is going to make provision for that, for such losses or liability. That's what the oil insurance is all about. Now the next thing we have is the cargo insurance. The cargo insurance means making provision for the damage made to the cargo in the ships. So if any losses or damage or perils which caused by the sea to the cargo, the insurance company is going to make provision for such loss and liability that arises from that. Now the next one is the ship owners insurance. This is also a form of marine insurance in which the insurance company make provision against any form of damage or liability that arises from the damage caused by the owners of the ship or by its employees as a result of mishandling of the cargoes in the ship, or the handling of the crew of the ship and some other things like that. So what will happen is insurance will make provision for such damages or losses that arise as a result of that. Now the next thing is the freight insurance. This type of insurance is also a type of marine insurance in which the insurance company make provision against any form of refusal of payment of freight. So when there's any form of refusal of payment of freight, what will happen? The insurance will going to make provision for that and must make compensation upon such a refusal of rights. Now we have different type of marine insurance policies. We have the time policy, we have the voyage policy, we have the floating policies, we have the mixed policy, that is the combination of time policy and voyage policy. This is actually the time within a certain period of time, and this is taken with what in a particular voyage or carriage so of goods. And we have the mixed policy, we have the open cover policy. We also have okay, we'll talk about the mixed policy. We also have the value policy and so on and so forth like that. Now marine losses, we have two types of marine losses. We have total loss and we have partial loss. Now next one we'll be looking at is life insurance. Life insurance. So we'll be looking at the life insurance. So the next thing we have on the list is the life insurance or life assurance. So when talking about the life assurance, is actually making provision against any losses or liabilities that arises from the death of a person. So any losses that arise as a result of the death of a person, insurance company is going to make provision against that. It means life assurance make provision against a person, not actually against a property. So when talking about life assurance, we have different type of life assurance that can be taken, life assurance policy that can be taken. We have a term assurance policy. We have the whole life assurance. We have the term assurance. We have the whole life assurance. We have the annuities. We have the annuity. We have the endowment policy. Endowment policy. Endowment assurance or endowment policy. So we'll be taking that one after the other. Now, time assurance. This is one of the oldest form of life assurance, in which a certain sum of money is paid to the assured person or to the insured person, and that's when the assured person dies. So when the assured person dies, what happens? A fixed sum will be paid to the assured person, and it's okay. And that will be depends within a fixed period of time. So if the assured person die or the insured person die within a fixed period of time, what will happen? Compensation will be paid to such person, the such family of the person. So now we also talk about the whole life assurance policy. The whole life assurance policy, wow, this is also an interesting policy that can be taken by a person. So this actually deals with the policy whereby compensation will be made by the insured person to the assured person if the person at the end of the death of the person. So if the person is payable at the death of the person. So if the person die, so compensation will be what will be paid to the family of the person. But actually this does not deal with whether the person died within a fixed period of time or not. So this is usually paid at death. So it's usually paid at death. So this is also the fixed a strict form of life assurance policy. So it's within a certain period of time. That person must be able to die within a certain period of time before compensation can be paid. But this one is usually paid at death of the person. So once the person died, what happened? Compensation will be paid to the dependent of the person. Now the next thing we can talk about the annuities policy. This usually deals with fixed payment of certain amount of money in the hands of the life of the person if the person dies. So money will be made frequently, fixed sum of money will be made frequently, fixed amount of money will be made frequently in form of annuity to the person until the death of the person. Now we have the endowment policy. Wow, this is also an interesting one. This one ensures that the person make a certain amount of premium, and what happens? Amount of money will usually be paid within a certain fixed period of time. So a last sum of money, the lump sum will be made available to that person, whether at the death of the person or within a fixed period of time. So it means when a person make an endowment policy, what happen? A lump sum will be made available to such person at the point of death or within a fixed period of time based on the agreement between the insurance company and the assured person. Now we are going to look at the reasons for taking life assurance policy. We have a lot of reasons for taking life assurance policy. One, to have a large lump sum. To have a lump sum on retirement when taking endowment policy. It's not compulsory you have you die before you can have you can take an endowment policy. You can do that within a fixed period of time whereby a fixed amount of money will be paid, whether at your at the period of death or within a fixed period of time. So that can serve as what to meet retirement. So a lump sum will be made available at retirement, and also it can also be used to provide for dependents. So any form of life assurance policy taking can be made to provide for dependent, and also to meet old age. We can use life assurance policies to meet old age, and also we can make life assurance policies taken to collect to secure loan, or to take it as a collateral security. We can use as a collateral security to secure loan in the bank, and also we can also use the policies as the source of a loan repayment. You can use it in paying loan and some overcharges made by the bank. So that is one of the reasons for taking life assurance policy. Now the next thing we have is the fire insurance. So the next thing we have is the fire insurance. We have the fire insurance. So the fire insurance is making provision against any form of liability and losses that arises from the burnt of a property which is caused by fire. So whenever a property got burned as a result of fire, what happened? Insurance company or an insurance is going to make provision for such a loss. So fire insurance can be taken to make provision for such a loss. So that is what fire insurance is all about. Now we're going to look at underwriting and reinsurance. We're going to look at who an underwriter is and also how to underwrite a risk. So underwriting is just like a process in which a merchant, which is an underwriter, takes to cover and take portion of a particular risk and also assume that portion of the risk. So it means that arises as a result of that. Maybe an insurance company might have large portion of a risk, so and the underwriter will take part to cover a particular portion of such a risk and also assume the portion of such a risk. So person that takes part in underwriting such a risk is called an underwriter. So it's the person that takes charge of the words. So it is the merchant that takes part to cover a particular risk and assume such portion of the risk. So the person that did that is underwriter, and the process of taking cover of the risk and also assume the portion of such a risk is called It's called underwriting. Now the next thing we have is the reinsurance. Reinsurance. So the process of issuing some part of reassuring some part of the risk of an insurance company with another insurance company. An insurance company can reinsure its risk if the risk is large with another insurance company. So the process of doing that is called reinsurance. It means it's the process of pulling risks. We call it the process of pulling risks from one insurance company to another insurance company. So risk can actually be transferred from one insurance company to another insurance company. So the process of doing that, we call it the process of reinsurance. The next thing we have on the list is the middlemen or intermediaries. So usually we have two middlemen or intermediaries in insurance contract. We have the insurance agent and we have the brokers. We have the insurance agent and we have the brokers. So what is the function of the insurance agent? The function of the insurance agent is to act, or the function the insurance agent is actually working with the insurance company, and their function is usually to look for potential insured person that actually insure their property with the insurance company. So they work with the insurance company and help the insurance company in looking for potential clients or potential customers that actually insure their risks with the insurance company. So we can have two type of insurance agent. We have permanent agent and have temporary agent. So the permanent agent actually work permanently with the insurance company, and temporary agent permanently with the insurance company. Or next intermediary or middleman we have is the brokers. Wow, interestingly, the brokers is just an intermediaries that work with just like as an intermediary between the insured company, between the insurance company and the insured person. So it links the insured person with the insurance company by bringing the insured person to the insurance company. That means for a commission called brokerage, it's working for a commission called brokerage. So the broker is going to look at, we're going to look for a potential client. The insurance is working on its own and look for a potential client who is interested in undertaking an insurance contract. So when the potential contract is about potential client has been seen by the brokers will tell the client all about the necessary information. That is we're going to give necessary information as regard to the insurance contract and how much required by the person. So that was the broker is going to link the insured person with the insurance with the insurance company, that is the insurer, and help the clients to secure or take an insurance policy. So that is the function of the broker, and brokers is usually working for that, for on a commission. It's working on a commission called brokerage. So it's working on a commission, it's what they call brokerage. Working on a commission called brokerage. Now the next thing we have is the importance of insurance. We have different branches of importance of insurance. Is that number one, the importance we can actually see on insurance is as number one, to make provision for old age. It enables to make provision for old age. Now any insurance policy can be used to secure loan from bank. And any insurance policy can be used as a collateral security. As a collateral. So this can be used as a collateral. So it can be used as a collateral. You can use that to secure loan, and also to provide for. It also enables us to have a lump sum for retirement. So telling a person having such a this thing for having a lump sum for retirement. So we have a lot of importance of insurance. So this is the major one I'm going to look at. It enables the person to provide for old age. Also it enables the person taking the insurance policy to provide for dependence. So you can easily provide for the dependent, like the young ones and children and the rest like that, and family. So these are the importance of insurance. So make provision for old age, secure loan from banks, and also it can be used as a collateral security, lump sum for retirement, and also provision for dependence, to provide for dependence. So the next one we have here is terms frequently used in insurance industry. So procedures of insurance contract. How is an insurance contract is to be taken? We are going to look at the procedure. The procedure is very, very, very simple. The first thing is to meet with an insurance agent or with a broker. So we're going to explain all of the policy of an insurance company to us. So the next step is for us to actually have an insurance policy note. So we're going to have the cover notes. Then we are going to fill the form. We are going to fill the form necessary. We are going to give all the necessary information as regard the policy we have to take. So once we fill the cover note, once we fill the insurance form, that is the proposal form. Once we fill the proposal form, the next thing is for us to pay the premium, the initial premium. So after paying the initial premium to the insurance company, what happened? The insurance policy have been made. So that is a very simple process. So have an inquiry from a broker. The first step, which is asking the broker on how the policy is. So what is the importance of taking the policies? It's going to explain everything to you. So how is the policies to be taken? What are the required information that I have to be disclosed in the process of taking such a policy? So after having such an information, the next thing is to have a proposed note. So after having the proposal note or the proposal form, fill the form, and also the next step is to pay premium to the insurance company. That is a fixed amount of money that have to that have to be paid to retain the insurance contract. So after making such a premium, the next thing, you have an insurance policy note. So the insurance policy note means that that's what the person have taken the what an insurance policy. So that is the procedure for taking what an insurance contract. Then the next thing is terms frequently used in insurance industry. So the next thing is to move the terms frequently used in insurance industries. So we have different terms used in insurance industry. We have the actuary, we have the proposed form, we have the cover note, we have the insurance policies, we have the premium, we have the surrender value, we have the insurer, we have the insured, we have the jettison, the brand card, and the barratry. So the first thing we have is the actuary. The actuary is actually a person in the life assurance policy who is responsible for calculating the risks and the premium in the policy. So the person is actually calculating and estimating the amount of risk, and also handling some pension funds, and also calculating the amount of premium to be paid by the insured person. Now the next thing is the proposed form. This is the form given to the insured person taken to take an insurance policy. So that will be using getting the details of the insured person, who is interested in taking an insurance policy. So the form that will be given as an initial form that will give out of the details of the insured person is called the proposed form. So the next thing, you have the cover note. The cover note serve as the note given to the insured person when the insurance policy is not fully processed. So it's usually given as a temporary note to ensure that the insured will be able to enjoy the benefit of the policies before the contract is fully processed. So that's what we call the cover note. It serves as a temporary note, and it is issued to the insured person to enable him to enjoy the benefit of the policy taken over before the policy is being fully processed. So that's what we call the cover note. The next thing we have now is the insurance policy. So the insurance policy is that this actually shows the total contract. The contract, so it is usually issued to the insured person, and that shows the contract between the insured person and the insurer, that is the insurance company. It shows the policy between the insurance, and this actually means the contract between them has been fully processed. So once it has been fully processed, an insurance policy note will be given to the insured person. So that's what we call the insurance policy. So the next one is, and that shows all of the details of the contract between the insured and the insurer. Now the next thing we have is the premium. This shows the fixed amount of money that will be paid by the insured person to the insurer within a certain period of time. So it's showed, and this money can be paid monthly, weekly, can be paid yearly, based on the agreement of the contract between the insured and the insurer. The next thing is the surrender value. Surrender value. Wow, the surrender value shows the amount in cash that have to pay to the insured person under the endowment policy, that is under the life assurance. So under the endowment policy, if the insured person refuses to continue with the contract, so if the insured person refuses to continue with the contract, so the amount of money that will be returned back to the insured person is called the surrender value. Now the next thing, we have the insurer, and an insurer is an insurance company. It's called an insurance company. So the insurer in the contract is an insurance company, a person that undertakes to insure another person against loss and liability is called the insurer. Now the insured person is the person that will be compensated as a result of loss and or liability that arises. So and that person will be compensated by the insurer. He is going to be compensated by the insurer. The next thing we have is jettison. Wow, jettison. This actually occurs when the captain of a ship, when the captain of the ship deliberately thrown away some cargo, some goods from the ship as a result of in order to satisfy the interest of the owners of such cargoes, because and the reason is to lighten the ship, because the captain can easily did that deliberately in order to lighten the ship, maybe if the ship is in form of problems and and the ship is what is prone to what, to the perils of the ship and damage of the ship. What happened is what the ship captain can easily what did that deliberately by what throwing away some cargoes or some goods from the ship in order to what to the sea, in order to what to lighten the ship, and that actually goes in the interest of the ship owners. The next one we have the brand card. Wow, this actually used within the West African sub-region and is usually given to the motorist wishing to travel within the West African sub-region. So, and once the person wishes to travel within the West African sub-region, the person is required to hold the brand card. You own the brand card to show that the person has taken a live employer liability policies, that the person has taken a liability policies with an insurance company. So now the comprehensive insurance policy. And the next thing we have the barratry. The barratry means this card is actually used in West Africa. Now the barratry means when a captain of a ship actually carry out an instruction or carry out an order which is contrary to the order of the ship owners. So carry out some decision which is contrary to the interest of the ship owner. So in such situations, we term situation barratry is called the barratry. So when the decision of the ship captain is contrary to the interest of the ship owner, so that becomes a barratry in under insurance. So these are the terms used in insurance policies. Okay, this has been an interesting class. We've treated definition of insurance and assurance. We talk about insurable and non-insurable risks. We go to the basic principle of insurance. We look at types of insurance, that is marine insurance, life insurance, fire insurance. Look at the underwriting and reinsurance. A person that take over the cover and assume some portion of the risk is called the underwriter, and the process of doing that is called underwriting. We look at the middlemen and intermediaries, that is the brokers with the insurance agents, who might be a permanent agent or a temporary agent. We also look at the importance of insurance. We look at the procedure of insurance contract, and lastly we look at the terms frequently used in insurance industry. So if you have any question or any confusion as regards to this topic, please do not hesitate to watch. So we play the video, and again some questions will be displayed on the screen. Do well to attempt such questions. Thank you.